Can you handle losing 8 trades in a row multiple times per year? That's normal with a 3-to-1 risk-reward system, and it's a big reason why most traders fail while professional firms quietly use something completely different. Professional trading firms don't use 3-to-1 risk-reward ratios, yet every YouTube guru religiously swears by them as if it were the golden rule of trading. Today, I'm going to break down exactly why the trading advice that sounds the smartest, never risk more than you can make, always go for 3-to-1 or better, is actually setting you up for psychological destruction and account blowups. We're going to look at the math, yes, but more importantly, we're going to look at what happens to your brain, your equity curve, and your prop firm challenge when you're sitting through your 8th consecutive loss because you're hunting for that perfect 3-to-1 setup. You've heard this 1,000 times. Your risk-reward ratio should be at least 2-to-1, ideally 3-to-1 or better. The logic sounds bulletproof. If you risk $100 to make $300, you only need to win 25% of the time to break even. Simple math. And you know what? That math is correct. It's just completely useless. What actually matters is what happens in the messy, frustrating, psychologically brutal reality of executing these trades day after day, week after week. And when we look at that reality, the 1-to-1 system doesn't just win. It absolutely demolishes the 3-to-1 approach. Let's talk about something every trading educator conveniently forgets to mention: losing streaks. Not one loss, not 2 losses. I'm talking about those soul-crushing stretches where nothing works, where every trade stops you out, where you start questioning whether your edge doesn't work anymore. Here's the thing. These losing streaks aren't rare events. They're not anomalies. They're mathematical certainties. And how often they happen changes dramatically based on your win rate. Let's compare 2 traders. We'll call them Sarah and Mike. Sarah trades a 1-to-1 risk-reward system. She risks $100 to make $100. Her win rate is 55%. Not spectacular. Not even that impressive, right? Mike trades a 3-to-1 risk-reward system. He risks $100 to make $300. His win rate is 35%. Still above that magical 25% break-even point. On paper, both of these systems can be profitable. But here's where conventional trading education completely fails you. They assume that what works on paper works in reality. It doesn't. Think about it logically. If Mike is only winning 35% of his trades, that means he's losing 65% of the time. He loses almost 2 out of every 3 trades. That's a lot of red in your trading journal. What do you think happens when you lose 2 out of every 3 times? You hit brutal losing streaks. A lot. 5, 6, 7, 8 losses in a row isn't some rare black swan event for Mike. It's a normal Tuesday. Sarah, on the other hand, wins 55% of the time. She's winning more than she's losing. Her losing streaks are shorter, less frequent, and less psychologically devastating. She might hit 3 or 4 losses in a row occasionally, but 8 or 10? That's extremely rare for her. Here's the brutal reality. Mike is going to experience long, soul-crushing, losing streaks regularly. Sarah isn't. And that difference matters way more than any mathematical edge on paper. Here's what's happening in Mike's head during a losing streak. After loss number 4, he's starting to doubt. After loss number 7, he's going through his entire trading plan looking for what's wrong. After loss number 10, he's on Reddit asking if his strategy is broken. He's checking if there's some fundamental shift in the market. He's wondering if he should just quit trading. And here's the really brutal part. There's nothing wrong with his system. This is exactly what a 35% win rate system does. This is the normal operation. But Mike's brain doesn't know that. His brain thinks he's failing. His brain is screaming at him that something is broken and he needs to fix it immediately. Meanwhile, Sarah, with her 1-to-1 system and 55% win rate, she might hit 3 or 4 losses in a row occasionally. It's uncomfortable, sure, but she's winning often enough that she never falls into that psychological death spiral. She gets a winner before her confidence completely collapses. This isn't theory. A study from the University of California analyzed thousands of retail traders and found that traders who experienced consecutive losses of 5 or more trades performed 23% worse on their subsequent trades. Not because their strategy changed, but because their psychology was compromised. Let's get into what's actually happening in your skull when you're losing trade after trade. Research at MIT revealed that when traders experience losses, Their bodies responded the same way they would if they were about to get into a physical fight. Heart rate spiking, adrenaline pumping, the whole deal. But here's what's really interesting. It wasn't the size of the loss that mattered most. It was the frequency and unpredictability. The research showed that a trader who lost $1,000 but won regularly showed moderate stress responses. A different trader who won $3,000 occasionally but lost $1,000 repeatedly showed severe stress responses, even though mathematically they were both making money. Your brain isn't a calculator. It's a survival machine that evolved to detect patterns and avoid threats. And consecutive losses trigger ancient threat detection systems that don't care about your expected value calculations. There's another concept called reward prediction error. Basically, your brain releases dopamine not when you get a reward, but when you get a reward that's better than expected. This is why slot machines are addictive. Unpredictable rewards create massive dopamine hits. Trading with a 55% win rate creates a relatively stable dopamine environment. You win fairly often. Your brain stays balanced. You can think clearly. Trading with a 35% win rate creates a dopamine drought. Your brain is constantly predicting a win because that's what you're trying to do. This prediction error, repeated over and over, doesn't just make you feel bad. It actually impairs your decision-making ability. Research shows that repeated negative prediction errors decrease activity in your prefrontal cortex, the part of your brain responsible for rational decision-making, while increasing activity in your amygdala, your fear center. In plain English, losing repeatedly makes you dumber and more scared. Now let's talk about learned helplessness. This is a concept from psychology where if you're repeatedly exposed to negative outcomes you can't control, you eventually stop trying to control anything. Martin Seligman did these famous experiments with dogs. He found that if dogs experienced random negative events they couldn't escape, they eventually stopped trying to escape even when they could. The same thing happens to traders on extended losing streaks. After enough consecutive losses, your brain starts to believe that your actions don't matter, that you can't control outcomes. And when you believe that, you either stop trading entirely or you start taking terrible revenge trades because it doesn't matter anyway. This is why Mike, our 3-to-1 trader, is psychologically doomed. He might have the same expected value as Sarah. He might even have a higher expected value, but he's constantly being psychologically battered in a way that Sarah isn't. The winner's effect. Now let's flip this around and talk about what happens when you win. There's this incredible phenomenon in neuroscience called the winner's effect. They found that when an animal wins a fight, its testosterone levels spike, which makes it more likely to win the next fight, which spikes testosterone again, creating a winning feedback loop. John Coates, a former Wall Street trader turned neuroscience researcher, studied this effect in traders. He measured testosterone and cortisol levels of traders throughout the trading day. What he found was remarkable. Traders who had a winning morning had significantly elevated testosterone in the afternoon. This wasn't just a feel-good effect. Higher testosterone actually improved their pattern recognition, risk assessment, and execution speed. They made better trades because they had won earlier. Conversely, traders on losing streaks had elevated cortisol, the stress hormone, which impaired their cognitive function. Here's why this destroys the case for 3-to-1 risk-reward ratios. The winner's effect requires winning frequently enough to maintain it. Sarah, winning 55% of her trades, is almost always operating in a positive psychological state. She might lose 2 trades, but then she wins 2 or 3. Her testosterone stays elevated, her confidence remains high, her decision-making stays sharp. Mike, winning only 35% of his trades, spends most of his time in a cortisol-elevated, confidence-depleted state. Even when he wins big, he knows statistically that several losses are probably coming. He can't maintain the winner's effect because wins are too infrequent. This creates a devastating feedback loop. The psychological difference between 55% and 35% isn't just 20 percentage points. It's the difference between operating in a virtuous cycle versus a vicious cycle. Equity curves, smooth versus chaotic. Let's talk about what these different systems look like on an equity curve graph when you actually trade them. Sarah's 1-to-1 system with 55% win rate produces an equity curve that looks like a staircase: up a step, down a step, up 2 steps, down a step, up a step. It's not smooth. Trading never is, but it's relatively steady. The upward trend is clear, the setbacks are modest. Mike's 3-to-1 system with 35% win rate produces an equity curve that looks like a damn roller coaster. Long stomach churning drops interrupted by occasional massive spikes. The overall trend might be up, but you need the discipline of a Tibetan monk. There's a statistical measure for this called variance, and later we'll talk about standard deviation. But forget the technical terms for a second. Just think about what it's like to trade these two equity curves. With Sarah's smooth curve, you wake up most days feeling okay. You're not getting rich overnight, but you're not bleeding either. You can see progress, you can trust the process. With Mike's chaotic curve, you wake up most days feeling anxious. You're either down significantly from your peak, wondering if you've lost your edge, or you're up significantly but knowing that a drawdown is probably coming. You can't trust the process because the process feels broken most of the time, even when it isn't. Researchers have actually quantified this. There's a metric called the ulcer index that measures the psychological pain of drawdowns over time. It's literally named after the stress-induced ulcers that volatile equity curves can cause. In backtests comparing identical expected value systems with different win rates, the lower win rate systems, like Mike's 3-to-1, consistently produced ulcer index scores 2 to 3 times higher than higher win rate systems, like Sarah's 1-to-1. This matters because trading isn't just about math, it's about whether you can execute the math. And you can't execute if you're psychologically destroyed by the natural variance of your own system. Mike might abandon his 3-to-1 system right before it hits its big winning streak. He's been losing for weeks. He's down 15%. He decides the system is broken and stops trading it. Then the market trends, and his system would have caught a massive winner that would have made his entire year. Sarah never faces this temptation because her equity curve never gets painful enough to trigger abandonment. She stays in the game. And in trading, staying in the game is 80% of winning. The prop firm meat grinder. Now let's talk about prop firm challenges. Because this is where the difference between 1-to-1 and 3-to-1 systems becomes brutally obvious. Most prop firms have similar challenge structures. You get a $100,000 demo account. You cannot exceed 10% drawdown at any point. If you hit the drawdown limit, it's game over. Let's run the numbers on how Mike and Sarah perform in this environment. Mike, with his 3-to-1 system and 35% win rate, is taking $1,000 risk per trade, 1% of account. Let's say he takes 1 trade per day on average. Over 30 days, he'll take about 30 trades. With a 35% win rate, he'll win roughly 10 trades and lose 20 trades. But here's the thing, those wins and losses won't be evenly distributed. They'll cluster. Remember our losing streak analysis? There's a very real chance Mike hits 8 or 10 losses in a row during the challenge. Just 8 losses in a row puts him at negative $8,000, which is an 8% drawdown. He's now terrifyingly close to blowing the challenge with almost no room for error. And remember, this is normal operation for a 35% win rate system. He's not doing anything wrong. The system is working exactly as designed. But the prop firm challenge structure doesn't care about long-term expected value. It cares about what happens in these specific 30 days. Sarah, meanwhile, with her 1-to-1 system and 55% win rate, is also risking $1,000 per trade. She takes 30 trades over the month. She'll win roughly 16 and lose 14. Her worst-case losing streak is probably 4 or 5 trades. That's a $4,000 to $5,000 drawdown, uncomfortable, but she's nowhere near the 10% limit. She has breathing room. She can keep trading without fear. A Monte Carlo simulation shows the 1-to-1 system with 55% win rate passed 67% of prop firm challenges. The 3-to-1 system with 35% win rate passed only 41% of challenges. If you're trading the 3-to-1 system, you'll probably need to buy 2 or 3 challenges before you pass one. That's more than $1,000 in sunk costs before you even start trading a funded account. With the 1-to-1 system, you'll probably pass on your first or second attempt. This is why prop firms, in their internal training, don't actually teach 3-to-1 risk-reward ratios. They teach whatever gives their traders the highest probability of consistent, low-volatility returns. Because they know that traders who blow up psychologically don't make them money. Trade frequency advantage. Mike's hunting for 3-to-1 setups. These don't come around often. Why? Because the market needs to offer you 3 times the distance to a target as you're risking to a stop loss. This requires very specific conditions. Strong directional moves with tight consolidations that you can hide your stop behind. In a typical trading month, Mike might find 8 to 12 high-quality 3-to-1 setups. He's being patient, he's being selective, he's doing everything right. Sarah's looking for 1-to-1 setups. These are everywhere. Any decent support or resistance level, any breakout with momentum, any pullback in a trend. She's finding 20 to 30 solid setups per month without compromising quality. But wait, you're thinking, aren't more trades just more opportunities to lose? Only if you don't have an edge. If you have a genuine edge, then more trades means more opportunities to express that edge. Let's talk about what this means practically. First, there's the learning curve advantage. Every trade is a data point. Every trade teaches you something about your strategy, about market conditions, about your own psychology. Sarah is getting 20 to 30 data points per month. After 6 months, she's got 120 to 180 trades in her sample. That's enough data to actually know if her system works, what her real win rate is, and how she personally handles the psychological aspects. Mike's getting 8 to 12 data points per month. After 6 months, he's got 48 to 72 trades. That's barely enough to distinguish between skill and luck. He doesn't really know if his system works or if he just got lucky or unlucky during this particular 6-month stretch. Second, there's market adaptability. Markets change. Sometimes they trend, sometimes they chop. Sometimes volatility is high, sometimes it's dead. Sarah's taking enough trades that she sees these changes quickly and can adapt. She notices when her win rate drops from 55% to 48% and can investigate why. Maybe her system needs tweaking for current conditions. Mike takes so few trades that he won't even notice market changes until months have passed. By the time he has enough data to realize something's different, the market might have changed again. What professionals actually do. Almost no professionals obsess over risk-reward ratios the way retail traders do. Go look at what firms like SMB Capital teach their traders. They emphasize win rate, consistency, and psychological management far more than they emphasize risk-reward ratios. Jane Street is one of the most successful trading firms in the world. You know what their risk-reward ratio is on most trades? About 1-to-1. They're not trying to hit home runs. They're trying to make small, consistent profits on massive volume. DRW Trading, another elite prop firm, uses strategies with high win rates and relatively tight risk-reward ratios. They scale position size, manage risk dynamically, and focus on execution quality. The 3-to-1 risk-reward obsession is almost exclusively a retail trader phenomenon. And you know why it persists? Because it sounds smart. Because it's simple to teach. Because it makes for good YouTube content. Just risk $100 to make $300. That's a 3-to-1 ratio. You only need to be right 25% of the time. It's a compelling story. The problem is that compelling stories and effective trading strategies are not the same thing. Professional traders think in terms of edge and execution, not in terms of fixed risk-reward ratios. They ask, what's the highest probability setup I can find? What's my edge in this specific market condition? How can I manage this position dynamically to maximize expected value? Fixed risk-reward thinking is rigid. Markets are fluid. You need fluid strategies. I'm not saying professionals never use wide risk-reward ratios. Of course they do when it's appropriate, when they're playing for large moves in strongly trending markets, when they're position trading over weeks or months, when the setup genuinely warrants a distant target. But they're not dogmatic about it. They're not automatically rejecting trades because they're only 1-to-1 or 1.5-to-1. They're taking whatever the market is offering that has positive expected value, and they can execute consistently. When 3-to-1 actually makes sense. I'm not here to tell you that 3-to-1 risk-reward ratios are always wrong. Context matters. There are absolutely situations where wider risk-reward ratios make sense. If you're position trading on higher time frames, daily or weekly charts, you might have very clear technical levels that justify wide targets. A breakout of a major consolidation that's been building for months might genuinely offer 3-to-1 or 5-to-1 potential. Take it. If you're trading in strongly trending markets, trailing your winners and letting them run makes total sense. You might enter targeting 1-to-1, but end up with 3-to-1 or better because the trend extends. That's great. That's proper trade management. If you have a specific setup that you've backtested thoroughly and it legitimately produces profitable results with wide risk-reward ratios, then trade it. But crucially, you need to have tested it across hundreds of trades and multiple market conditions. You need to know your real win rate, your real maximum drawdown, your real psychological tolerance for the losing streaks. The problem isn't with 3-to-1 risk-reward ratios themselves. The problem is with the dogmatic advice that you should always be aiming for them regardless of context, market conditions, or your trading style. Some traders have the psychological makeup to handle low win rates. They genuinely don't get fazed by losing streaks. They trust their system completely. They have sufficient capital to weather large drawdowns. For these traders, wider risk-reward ratios might be optimal. But for most traders, especially newer traders, traders with smaller accounts, traders doing prop firm challenges, traders who need consistent income, the 1-to-1 approach is almost always superior. Be honest with yourself. If you can psychologically handle the 3-to-1 system's variance and losing streaks, and if your backtesting supports it, then trade it. But if you find yourself constantly tempted to overtrade, revenge trade, or abandon the system during normal drawdowns, then you need a higher win rate approach. The best risk-reward ratio isn't the one with the highest expected value on paper. It's the one you can actually execute consistently given your psychology, capital, and life situation. Conclusion. Let's bring this all together. The trading education industry has sold us a bill of goods with the obsession over wide risk-reward ratios. It sounds sophisticated. It sounds professional. I only take 3-to-1 setups. Sounds impressive when you say it. But when you actually examine the mathematics of losing streaks, the neuroscience of consecutive losses, the psychological impact of volatile equity curves, the reality of prop firm challenges, and what professional traders actually do, a very different picture emerges. Higher win rates with tighter risk-reward ratios aren't just acceptable, they're often superior for most traders in most situations. A 1-to-1 system with a 55% win rate will outperform a 3-to-1 system with a 35% win rate for most traders, even when the expected values are identical, because you'll experience dramatically fewer and shorter losing streaks. Your psychology will remain stable instead of deteriorating. You'll benefit from the winner's effect instead of battling learned helplessness. Your equity curve will be smoother and less psychologically painful. You'll have a much higher chance of passing prop firm challenges. You'll trade more frequently, learning faster, and earning more consistently. You'll find your live performance matches your backtesting better. Trading isn't just about mathematical expected value. It's about psychological sustainability, execution consistency, and being able to stay in the game long enough for your edge to play out. The trader who survives and thrives isn't the one with the most impressive risk-reward ratio. It's the one who can execute their strategy day after day, week after week, month after month, without being psychologically destroyed by the natural variance of markets. My challenge to you: stop chasing impressive, sounding risk-reward ratios and start building systems you can actually trade consistently. Test both approaches with your own data. Be honest about your psychology. Find what actually works for you, not what sounds good in a YouTube comment section. Because at the end of the day, the best trading system isn't the one with the best hypothetical returns. It's the one you'll still be trading a year from now. The professionals know this. Now you do too.